today, the Hertz bankruptcy rally may be starting to stall out. Also, Spotify shares surge after the company gives its podcast the full Hollywood treatment. And finally, we dive into the sales of one company that has been an under-the-radar winner of the stay-at-home economy. I'm MacKenzie Sigalos, and this is CNBC After Hours. Let's start off with a look at Wall Street's day. A mixed bag for stocks after jobless claims, aka the number of people applying for unemployment for the first time, came in higher than economists were expecting. It also came amidst growing coronavirus outbreaks, especially in America's South and West regions. And take a look at shares of Hertz, down 10% today. Now, we talked last week about how shares of this company, which is bankrupt, have been on fire over the past few weeks, surging by triple-digit percentages as many retail investors on apps like Robinhood piled in. Now, at the same time, billionaire investor Carl Icahn ditched his stake in Hertz altogether and lost nearly $2 billion. Well, Hertz hit a roadblock this week, backing out of a plan to sell an additional $500 million of stock, which could have helped it raise new cash. Take a look.
Hertz just hit a bump in the road. The bankrupt rental car company called off its plan to sell up to $500 million in new stock. It was put on hold after the SEC chairman told CNBC that the agency had concerns.
For a company, any company, to sell stock in our public markets, there are a number of requirements, including disclosure. And there's liability for disclosure that is inadequate or incomplete in a material way. In this particular situation, we have let the company know that we have comments on their disclosure.
It's not terribly uncommon for the SEC to raise questions when companies say they want to sell new shares.
So when a company files with the SEC to sell a security, it's really normal for the agency to go back to them and say, hey, can you add this and can you disclose a little bit on that and elaborate on certain things?
But Hertz is different. The company is bankrupt, and it's very unusual for a bankrupt company to try to issue new shares. So why'd they do it? Well, it's a way to raise cash from public investors. And for the past few weeks, tons of people were buying Hertz's stock. On the other side of every buyer, there's a seller. By issuing new shares, Hertz itself could be the seller. And remember, Hertz is bankrupt. It probably needs the cash. Investors, especially individual retail investors, had been piling into the stock after the company filed for bankruptcy. Trading activity on Hertz and other bankrupt names spiked on Robinhood, an app popular with millennials and other individual investors. In the first week of June, Hertz skyrocketed 188%.
The nature of investing in the stock market is you buy low and sell high. But in this case, investors know if they have any knowledge about bankruptcies, they would know that they will get completely wiped out very soon. So you see those names really soaring in the last couple of weeks. It just speaks to how speculative this market rally has been because they're just trying to make a quick buck.
The thing about bankruptcies, though, is that the stockholders are usually the last people to get paid out in a bankruptcy proceeding. Whoever's left holding the stock will lose all their money. And Hertz knows this.
Earlier this week, when Hertz disclosed its plans to sell new shares, it said in its filing multiple times that potential buyers of the new stocks would be completely wiped out.
Hertz suspended the stock sale yesterday after Jay Clayton's comments on CNBC, but this afternoon, it officially terminated the share offering altogether. The company is now reportedly in talks with lenders to secure a bankruptcy loan.
Okay, let's get to our sound check. Here's a roundup of the day's biggest action and what the top newsmakers and business leaders had to say on CNBC's airwaves today.
I'm more concerned than I was 3 weeks ago heading into the fall for two reasons. Number one, the numbers are higher. The outbreaks are higher than I expected. We expected numbers to tick up, but these are outbreaks. I mean, we're seeing doubling times now, falling under 10 days. These are on the cusp of getting out of control. The other thing that makes me more concerned is just the political landscape and lack of political will to take mitigation steps.
Well, it's a 25-year-old piece of legislation, and it's kept the industry in a reasonably strong footing. It's obviously an economic success story, but it was designed originally to give safe haven or room for the industry to do more to protect consumers.
They are a part of a duopoly together with Google, where if you want to sell software, if you want to make software, you have to be on these mobile app stores. And they're saying, you know what? We're going to take a 30% cut of essentially all economic activity that happens on these platforms. And that's just preposterous.
But Apple hits right back, saying that this app just doesn't meet its guidelines. More broadly, Apple is going to argue it offers a secure platform and that developers, it points out, have earned over $155 billion since the App Store first launched back in 2008.
Our viewers are actually trying to make money. They're not sitting back and saying, that's not real money, that's the Fed's money. Jay Powell may look like a distinguished banker, but he's a complete wild man. No, I want that money for our viewers. Our viewers have every right to capture that money, despite many people coming on and saying, no, it's a bubble.
Over the past few months, as millions of Americans have been stuck in quarantine, we spent a lot of time talking about businesses and companies that stood to perform well under this new normal. So you had companies like Amazon and Netflix that provided services which thrived when people spent more time at home. There was the popularity of telehealth, which soared as patients could consult with their doctors without encountering the danger of a packed hospital. Even the baking industry saw a big boom. Sales of flour skyrocketed as everyone became a bread maker overnight. But one company that almost nobody is talking about is an under-the-radar winner of the stay-at-home economy. CNBC's Courtney Reagan has those details.
Well, it's one of the few retailers that can say it's now been through 2 pandemics because it's been around for more than a century. LL Bean is the one that fits this bill. Kind of an unlikely winner when you're thinking about the pandemic, but because it started as a catalog and much of its business is still direct to consumer, so online, over the phone, and through the catalog, 3/4 of its business, in fact, it was able to continue to serve shoppers throughout the different phases of the pandemic. And CEO Steve Smith tells me it was comfort that they saw first, then a focus on the backyard, and then consumers wanting to connect to the outdoors but beyond the home. So in March, for LL Bean, sales of slippers grew 95%, and there were also large spikes in anything else that a customer might consider cozy, a lot of flannel wear. And then in late April and early May, Smith says that shoppers busted outside. Hammocks were up 150%. Outdoor furniture up almost 80% in May. Consumers then kind of explored more, reacquainting with the outdoors and venturing beyond the home. Cycling, bikes, those were big. In fact, LL Bean's bike sales were up 400% in May. And its reopened stores have now sold out of a lot of the bikes. They've been selling a lot of kayaks and boat sales, up 96% last month. Now, 51 of 54 LL Bean stores are now reopened, but Smith said that while the catalog business had been declining for about 2 decades, that's turned around. More people are at home going through their mail, spending more time with that catalog. At least he thinks so, and he says he can't really attribute it to things like the beautiful photography, although he'd like to. He says, look, it's just sort of a winner at home because we sell all of the product categories that consumers are most interested in buying.
Okay, now for today's numbers round. We'll start with 100. San Francisco is considering an overpaid executive tax on companies where the highest earner makes 100 times more than the median company salary. The proposal will be on the ballot in November and would target companies that bring in over $1.17 million in revenue, requiring them to pay 0.1% of those revenues in a tax. Companies like JP Morgan, Chipotle, and CNBC parent company Comcast would all be affected if the tax goes through. Next, 2. Shares of Spotify hit a record today, trading at their highest levels since the company went public just over 2 years ago. The stock is soaring after the company made 2 high-profile podcast deals this week. Today, Spotify announced a new partnership with DC and Warner Brothers to produce a slate of new scripted shows featuring their iconic comic book characters. And yesterday, the Wall Street Journal reported that Kim Kardashian West signed a deal with Spotify to produce and co-host a criminal justice podcast. And finally, 500. At a virtual shareholder meeting earlier today, the Delta Airlines CEO said that about 500 of its workers have contracted COVID-19, 10 of whom have passed away. Now, no details were shared about whether these employees worked in corporate offices or interacted with passengers on flights. The CEO did say that the company would provide coronavirus testing for all its workers. That's it for After Hours, but before we go, here's one more thing to keep an eye on. Tomorrow, Samsung will release its new Galaxy A71 5G smartphone. At a price of $600 before you count in any carrier subsidies, this will be the cheapest 5G phone available on the US market. Get the latest on all the available 5G tech by going to CNBC.com and downloading the CNBC app. We'll be right here in our home office every Tuesday and Thursday with a new edition of After Hours, so be sure to catch us then.